I like that Bitcoin's held around 20K the last week or so. Just stacking as many sats as I can.
Right on. Yeah, it doesn't look too bad. I don't know. It's interesting to see. I mean, market indexes look good today and look like they're kind of outperforming Bitcoin here. It'll be interesting to see what happens this weekend.
Yeah, I mean, we've definitely seen a lot of pain in Bitcoin, and since Will's not here, I know a lot of the traditional or historical on-chain metrics. Pretty much everything is extremely oversold, which I don't know at this point. A lot of people don't give much credence to on-chain, and for valid reasons at this point. But it is. I agree. It's a great time to be averaging into Bitcoin.
For sure. All right, I can get going on some macro stuff here. Just basically talking about what I wrote about this week in the newsletter. And there's pinned tweets at the top. So mine has a thread of some of the charts I'll be talking about. If anyone wants to reference that. But I mean, so yeah, I'll talk a little bit about macro and the equity markets as well. Obviously, it's been a pretty big week for the equity markets, and I think there's a couple of reasons. There's a handful of reasons why some of that selling pressure has been alleviated. On the commodity side of things, you have crude prices have been pretty weak this week, right? It's down. WTI crude's down like 3% or something around there this week. It was almost at 124 a barrel last week. And a lot of this stems from the announcement that I believe came Wednesday from the White House, implementing a 3-month pause on federal gas and diesel taxes. So I don't think this is something that's going to take gas prices or oil prices down significantly. But it is like the strongest move that Biden's made so far. So if you're someone who maybe doesn't have a background in macro, I included in the newsletter. I forgot to put it in my Twitter thread there, but it's just the basic supply and demand graph. And just basically what's happening is, the Biden administration is trying to incentivize oil production. So, if you look at a basic supply and demand graph, and you can just Google supply and demand chart or whatever, and it'll be the first thing that pops up. But basically, if you increase supply, right, you're going to move that equilibrium price down the demand curve, and it lowers prices. Right, you have the same amount of money competing for more supply, which is going to lower prices. So they're incentivizing oil producers to go ahead and produce more oil by removing those taxes. And in my thread there, I included a graph of U.S. crude oil production. You can kind of see just that production's already moving up. And that's kind of just because that's how commodities work, right? When you have higher prices, it becomes more profitable to produce those goods. So currently we produce about 12 million barrels of oil per day, which is up year to date. And I think kind of the issue is with a 3-month tax holiday is getting oil drills online is a very time, labor and capital intensive process. It could take anywhere from 2 to 4 months to get a pump online. So removing the tax for 3 months, I don't know. It'll be interesting to see, I guess, if oil producers are going to think that's worth the hassle, if you will, of getting pumps online. And so the reason obviously they want to do this is of course oil higher gas prices hurt consumers, and energy is an input to pretty much all goods. So if you lower oil prices, you could hopefully, in theory, bring down CPI. And it's a midterm year, so they want the economy to be in a good spot going into those into that voting. But if you look at core CPI, which is CPI minus food and energy, it's still 6%, which is largest value in 40 years. And energy prices make up 2.6% of headline CPI, which is a significant number. But core CPI itself is still at 6%. So I don't know if the Biden tax holiday is going to be enough to encourage new oil production. And I guess we'll see is kind of the deal. And the main CPI driver of higher CPI values has been the monetary issues that we've had, expanding the money supply as much as we did over the last 2 years. But recently in the last month or so, the Fed began quantitative tightening. So letting the bonds that they own run off the balance sheet, and not reinvesting that principal. And so we've seen the first downtick in M2 money supply for the first time in 12 years, which is obviously a move in the right direction to lower prices, but there's still a ton of ground to cover if they want to suck some of that capital out of the economy. And you have these ongoing issues in the supply chain. So you have more money competing for less goods, created higher prices. So now if you have less money competing for those goods, hopefully you should bring prices down. But like I said, there's a lot of ground to cover. So moving on, to the fixed income markets, the bond markets, yields have been down this week. So you've seen bonds catching a bid, which is bullish for equities. And if you're a reader of the newsletter, you've seen me talk about that relationship between yields and equity pricing and Bitcoin pricing. I talked about it last week, pretty in depth. So if you missed that, I'd recommend going back to last week's letter and reading that. But essentially, falling yields are good for risk asset pricing, and that's because institutions and these big hedge funds and mutual funds, they use traditional valuation metrics to decide when to buy or sell stocks. So a lot of them use the present value equation. So that's present value equals future value divided by 1 minus the discount rate to the power of the number of periods. So the discount rate is a bond yield. Generally, is the 10-year yield, which is considered the risk-free rate, because it's a treasury bond, and the U.S. Has never defaulted on their debt, so it's considered risk-free versus something like a corporate bond, where you have to hope, or you have to you're betting on the fact that that corporation is going to be able to repay their debt in the future. So bond yields have been falling this week. Treasury yields have been falling, which makes the present value of stocks increase, which causes institutions to buy, and that's exactly what we've seen this week. And if we look at if we take a deeper look into the fixed income markets and try to figure out where exactly is this money flowing into, I included a chart of, it's the white chart with the blue line. It's a chart of the 3 to 7 treasury yield divided by high yield corporate debt, or junk bonds. So this credit spread essentially tells us to what degree are treasury bonds outperforming junk bonds. So what we can see is that we've had an increase in this credit spread, meaning that more money is flowing into these treasury bonds relative to junk bonds. So what this says to me is that there is money flowing back into the bond market this week, but it's to a much greater degree going into those risk-free bonds, if you will, versus junk bonds into a risk asset. So that's something to keep an eye on. We would like to see some money flowing into these riskier bonds, which would flow over into the equity and Bitcoin and crypto side of things. But that's just something I wanted to point out there. And then obviously we've had a big week in the stock market. I talked a little bit about a fall through day today in the letter. That's something that I'm keeping an eye out for today, and that's essentially a signal of the market is attempting to put in a legitimate rally attempt. So that quote is that I repeat a lot, is that not every fall through day starts a bull market, but every bull market starts with a fall through day. So that's kind of, I have my eye on that. That's essentially what you're looking for is it's got to be at least day 4 following a market bottom. So today would be day 5 on the NASDAQ, day 4 on the S&P and Dow. But you're looking for, on day 4 or beyond, you're looking for a day where the index is up greater than 1.5%. So, it's up significantly, and it's on volume that's greater than the previous day. And like I said, that it's not a guaranteed signal, right? It doesn't mean if you get a fall through day, you jump back in with your full account and buy everything you can. It just, is a good indication that, hey, something, this is not just a 1 or 2 day bounce. This could potentially be, the start of a new uptrend. So that's something to keep an eye on. And I included a quote from one of my favorite books, Reminiscences of a Stock Operator, and I won't read the full thing here. You should go read the newsletter if you want to hear more about it. And it's almost 100-year-old quote. And it's, basically saying that, stocks follow the line of least resistance. So they do whatever comes easiest, right? If there's more pressure for stocks to continue falling, then chances are they'll continue falling. It basically just says that stocks are much more likely to continue the trend than they are to break it. So what this kind of says, and how this is relevant to us today, is just that, chances are, while this could be the market bottom, it could be, but the chances are greater that this is, just a bear market rally before we continue lower. So it's just kind of, stay on your toes kind of thing. I personally, wouldn't be, itching to jump back in right now. But, just be open to all possibilities, basically. But, I'm looking for confirmation from the market indexes, before I'm, super bullish. And today's been a strong day, right? The Nasdaq's above its 21 EMA. What's the S&P is, above its 10 EMA. It's almost to its 21 EMA. Which are bullish signs, and these are potential confirmation. But what I'd like to see is more confirmation from a price structure perspective. So I want to see, neither of these indexes have made a higher high since November 2021 when the market topped. So what I would like to see is them try to get over that peak that we made there in early June, June 2nd or so, which would be around 12,300 on the Nasdaq and about 4,200 on the S&P. So I think that is kind of, a good indication of, something special is going on here. And I don't think just because they cross above those levels doesn't mean that we're completely out of the water. But it would definitely make me a lot more confident that this could be a market bottom. And then, also I talked about, basically, we're in a bear market. We're arguably in a recession. But you can't officially say that we're in a recession yet. I think some of the best metrics to keep an eye on if you want to know how close we are to recession or if we're in a recession is to look at jobs data. So I've included in the newsletter a few times. I look at initial jobless claims, which are I think important, which tracks the amount of unemployment claims that people have filed with the government following losing their job. So this week I skipped that because I've talked about that a few times in the newsletter, and I brought up a couple other metrics, which are charts of which are in my thread that's pinned at the top of this space. So the first one I looked at was U.S. average weekly hours worked, and the reason why I'm looking at this instead of just initial jobless claims is because in a rising interest rate environment, right, it squeezes companies, and a lot of times that can lead to them firing employees. But generally, it takes a lot more time than that. They don't just start off with, oh, our interest rates are higher, we're just going to start firing people. It starts generally with, okay, let's just reduce the number of hours our employees are working, and then it's like, hey, let's pause our new hiring before you finally get to we need to lay off employees. So I think looking at the average weekly hours that people are working is important because that's kind of the first step, if you will. And it's been essentially flat this year. And also, this data is only released quarterly, so it's hard to get a current judgment of what's going on in the jobs market. But the next data points will be released in July, so that's something to keep an eye on. But yeah, the number of hours the average American is working is essentially flat on the year, which doesn't really give us a ton of information. So we can also look at the U.S. job openings rate. So the number of job openings that there are in comparison to the amount of jobs out there, and that is had a relatively significant downtick of recent in Q1 2022, and that's also a chart of that is included in that thread there. So like I said, you reduce the number of hours employees are working, and then you slow down your hiring process. So seeing a downtick in the job openings rate could be significant, but like I said, it's quarterly data, so it could be a little early to say whether or not it's truly significant. But yeah, that's pretty much all that I talked about. There's obviously a little bit more in the newsletter, a little bit more explanation. So highly recommend going and reading that. But yeah, that's all I got.
I have a question about the job stuff. Just looking at the last 2 years, because that's really been my time frame has been since COVID, and the job openings are way up, and hours have been pretty flat. And with all this inflation going on, how are people living? If there's all these openings, and hours are sort of down, at least in the last year. Like, how are people affording to live?
That's a good question. I think there's probably a lot to that, and I don't know if I can necessarily give you an answer based off job openings. But obviously, inflation squeezes your everyday American, right? And there's that quote, and it's basically just saying that inflation is a tax on citizens who can't grow their cash flows at the rate of inflation. And most people don't. You're not going to get an 8.6% raise this year because CPI is 8.6%, right? So inflation, squeezes your purchasing power, and it makes it more difficult to live. And that's why the White House and the Fed is so concerned about getting inflation under control, because inflation is a big hot button issue with voters. So I think it's for that it's really important to for them to get inflation under control, because obviously it's hurting their voter base and it's hurting the average American. But other than that, I don't know if I really have a strong answer for you.
Yeah, I guess that question sort of requires more speculation than like being able to have a quantitative answer. Yeah, if anyone wants to read more in depth about what Blake was just talking about, make sure to check out this week's newsletter. And Joe, we can pass it off to you. Talk about mining.
Awesome. Thanks, Mitch. Yeah, Blake, that was fantastic. I think recap of macro and in general. And I think two things that I wanted to mention that you pretty much covered, but I wanted to add my own thoughts as well. I know that you mentioned oil at the beginning, how prices are obviously relatively high. Like, we all notice that when we fill up our cars with gas. But like, I like this quote that's basically says the cure for high prices is higher prices, right? And so like, once oil prices reach this level, that's incentivizing these companies to go out and produce actually more oil, drill for more oil. And so I think like in the long term, like you're mentioning, in the short term, it's extremely difficult to all of a sudden bring up a bunch of oil production. But in the longer term, all of these companies, ExxonMobil, ConocoPhillips, and others, are building and starting these projects, and that's going to bring more supply onto the market. And eventually, prices are going to come down. Will that happen? Continue to happen like it has over the last few weeks? Will it happen over the next 3 months? Will it happen over the next year? I don't know. It could take some time, but yeah, eventually, like the real price of oil, in my opinion, will eventually come down. The other thing that I'm kind of looking forward to, like macro wise, is to see what the CPI number comes out at in mid July for the month of June. I think that's going to be interesting to see, as we like you mentioned, we've kind of seen the price of oil like slowly dropping a little bit over at least the last few weeks, and so it's going to be interesting to see, whether that's going to slow down inflation and maybe give the Fed some ammunition to like kind of lay off their hawkish tone. But who's to say? It's just speculation. But yeah, I'll jump into mining and quickly just recap like what I covered in the newsletter this week. But yeah, if you want to hear more about what Blake said, or you want to hear more about mining, definitely check out the Blockware Intelligence newsletter. I think the link's at least in my bio. Might be in Blake's and Mitch's too. But
it's in mine too. It's also in Will's bio.
Yep. Sweet. Exactly. Cool. Yeah. So jumping into mining, I'll just recap a few major metrics that most miners are looking at. So the 14-day moving average of the total network hash rate is now at about 209 exahash, which basically means there are still millions and millions and millions of ASICs hashing, trying to get this Bitcoin. We saw a negative difficulty adjustment this week, and we're actually projected to see another negative difficulty adjustment on July 7th as of now, or at least around then. So it's definitely a sign that, and I'm going to talk about this, but miners are on the net turning off machines. Some of these old generation mining rigs are capitulating. Like if they're plugged in, they're basically burning money. They're paying $1 of electricity to get 99 cents of Bitcoin. Obviously a bad business model. So we're kind of seeing these weak miners capitulating off the network, and that's why we've we've had, this past negative difficulty adjustment, and it looks like we might get another one soon. Other than that, hash price, which is a common metric that miners like to look at, which is the dollar that you earn per terahash per day. So if you have, an S19 that's 100 terahash, you're going to earn this metric times 100. So the current hash price for Bitcoin is 9 cents. So your S19 at 100T is making $9 a day in revenue. But yeah, going into how weak miners are capitulating and turning off those machines, there's a metric that I really love called hash ribbons, and it's one of the shared tweets in this space. And it kind of compares the 30-day moving average of Bitcoin's hash rate with the 60-day moving average of Bitcoin's hash rate. And when the 30-day dips below the 60-day, it's basically a sign that over, a significant amount of time that some hash rate is coming off the network. And so when hash rate comes off the network, like I was talking about, that's a sign that actual machines are turning off, which is a sign that the miners, at least some of them, are really seeing their margins compressed or potentially even non-existent. And so Bloomberg has actually done a great job, in my opinion, covering a lot of what's going on in the mining space. They did this cool chart that's in the newsletter that basically showed the number of Bitcoin sold by public miners since the beginning of this year. And it goes, January, February, March, April, May. And before May, it was all about 1,000 BTC being sold by public miners per month or less. May, we saw a massive jump to about 4.2 thousand Bitcoin. So about a 4x increase in the amount of selling from public miners. And obviously that's kind of this idea and a sign that miners are pro-cyclical. They kind of tend to hold and borrow money on the tops when Bitcoin is hot. And when things are bad, they end up dumping their treasuries, they end up dumping their rigs, and they end up basically capitulating. So, a lot of these companies, publicly traded companies, are struggling. That's being clearly reflected in their stock prices over the last 6 months as well. So it's a very interesting time in the mining world. Bitfarms recently actually sold about 3,000 Bitcoin just in the month of June, which was at the time it was 62 million. And they said to boost liquidity and basically to take on a more conservative strategy going forward. Going forward, though, I mean, it's hard to know exactly when this miner capitulation will end, but it's kind of good news that it at least has started, because historically these minor capitulations, once they're done, they've kind of marked bear market Bitcoin bottoms. And I think that the reason that occurs is because when these weak miners are purged from the network, those are the miners that are selling all their treasuries. They have very high operating expenses, so they're selling the Bitcoin that they mine to pay their operating expenses. After those miners are gone, the only miners that are left are the ones with strong balance sheets and low operating expenses. So the day-to-day sell pressure after these miner capitulations is significantly less than what it was before. But that's basically, the general idea of what's going on in mining. There's a lot going on. A lot of the large players are experiencing some tough issues, and I think a very important message, I guess, for Bitcoin holders and Bitcoin miners is make sure you have your balance sheet in a place where you can survive, because these bear markets obviously inevitably come. If you have a lot of debt, you're poorly positioned when that bear market comes, and you could risk completely getting wiped out. But we know eventually, this is Bitcoin. Bitcoin adoption is happening. It's the best monetary tool we've ever discovered. Another bull run is going to come. And if you are loaded up on debt and you barely can survive or you don't survive, that's just going to ruin the bull market. So you just need to survive. And then once the bull market inevitably comes back, that's when you're going to be in a great position to really thrive and take advantage of just the rapid adoption of Bitcoin.
Awesome. Yeah, that was cool. That's kind of, I was going to say, that's just kind of one of the reasons why I've been so bullish on public equities, and a lot of these companies have contracts with energy companies for fixed energy rates. But people that are plugging machines in at home or hosting them themselves, struggle with higher energy costs. But a lot of these companies, they're starting to sell some Bitcoin, to cover OpEx. But when you have these big companies with hundreds of rigs or thousands of rigs, new gen machines, and then you start to see some of those old gen machines start to turn off, and difficulty adjusts to that. I think it's a good time to be a public equity that is assuming you're low debt and going to survive this storm. I think it's an interesting time to be looking at publicly traded Bitcoin companies. Not that that's financial advice or anything, but it is just interesting to see that these companies are trading at 20% of the market cap that they were a year ago. It's just, I don't know, super interesting to look at.
Yeah, no, exactly. I mean, I think whether it's acquiring equity in these publicly traded companies or setting up your own operations or hosting, now is a pretty phenomenal time to be averaging in to these new generation rigs that, if you look at the price of how these rigs have traded in the past, it's a steal right now. Now you could have been buying S19 Pros for 10,000 plus, and now they're near 5,000. Now we have the new XP coming out at the end of July from Bitmain, which is going to be pretty much the best rig out there. To me, like these new generation rigs and the companies, publicly traded companies that have purchase orders for them and strong balance sheets to survive and this bear market, they're going to be in a great position to really capitalize on the next bull run. And also another thing that I always like to mention is these companies or these entities or you as an individual, when you get exposure to these new generation mining rigs, especially during times of miner capitulations right now, one, you're buying them at a great price because not many people are deploying capital into mining right now. But two, if old generation rigs and mid-generation rigs start turning off because the price is going down, their operating expenses are too high, that brings difficulty down, which means these new generation rigs actually start to see their break-even costs start to fall, and they begin earning more Bitcoin as the difficulty falls. So it's kind of like a good hedge against further price falls in Bitcoin, but it keeps it to where you're buying these rigs at a discount for where they were 3, 6, 12 months ago, and it enables you to still capture a lot of the upside that you'll see on, one, the appreciation of the rig, and two, the mining rewards. As when you buy new generation rigs, you still have solid margins when you're operating those rigs.
Yeah, it really is a great time, and you don't want to wait too long because, of course, the halving's coming in 2 years. So you want to get hashing as soon as possible to get as much Bitcoin as you can. And Joe, is there any word on the S19 XPs if they're going to be out soon?
Yeah, I mean, Bitmain, I believe, is releasing them at the end of July. I know Blockware will have batches late summer. But yeah, I know prices are available if you go to the Blockware website. I don't know what exactly they're going for right now, but yeah, they're coming out. Time to get hashing.
I remember you did a hash rate projection at the beginning of the year. Was that factoring in the XP coming on the market?
Yeah, the way I did it at the beginning of the year was basically analyzing a lot of what projections were done from public and private miners that were releasing their hash rate projections. I remember when the hash rate, everyone was doing like Galaxy, Luxor guys, and Blockware. We all did our hash rate projections. I remember looking at Galaxies, and I was like, "Wow, this is really high." And I didn't think that hash rate was going to be able to grow that quickly. And obviously, hash rate has not grown nearly as fast as any of us thought it was going to grow. A large part of that is from the price, obviously. But yeah, no, XPs will definitely cause hash rate to keep increasing, and I think that's going to continue to push off these old S9s and some of the mid generation machines like the S17s. especially if price doesn't start recovering, because those XPs are going to get plugged in somewhere. It's just a matter of time.
Awesome. If any of you join late, this space will be recorded and it'll be on YouTube later today or early tomorrow. So fear not. Joe or Blake, you guys got anything else you want to add before we head out?
No, I think that's it. At least on my side, Blake might have something to say, but Mitch, appreciate it for hosting. And yeah, guys, feel free to check us out, blockwareintelligence.com, blockwaresolutions.com. Give us a follow. My DMs are open if you have questions on Bitcoin or Bitcoin mining or macro. Here to help.
Yeah, I was just going to say the same thing. Just DMs are open if anyone had any questions about what we talked about today or what's in the newsletter. Recommend going and reading the newsletter. I think is a good one this week, even though we're missing Will for this one. But thank you all for tuning in.
Yeah, and if anyone's interested in getting rigs and getting online, make sure to send this account a DM or go to our website and fill out the contact form there, and we can talk. So that'll do it for this week. Make sure to look out for next week. We'll be doing this same thing. So hope you guys all enjoyed.
Awesome. Thanks, guys.
Peace out.